Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing in that order. Today is Wednesday, November 13th, 2024. Today's episode, we will start by bringing up the CPI coming out as expected. As always, on marketwatch.com, the right column is the last reading of this. The middle column was the market expectations, and the left column is the actual numbers. And as you can see across the board, we came out exactly as the market was predicting. The expectations lining up with exactly what was the actual numbers. I mentioned on yesterday's show that, if it was seeming like yesterday specifically, the market was starting to sniff out like extra worriedness about inflation being a lot higher than expected, and it wasn't. And so we had some interesting reactions. The lens I like to use regarding how the market is seeing CPI is what's going on with inflation expectations across markets. So starting with my favorite inflation gauge from the Fed website is the 10-year break-even inflation rate. From yesterday's reading of 2.35, we stayed exactly at 2.35. So the market priced it in exactly as expected before and after. We'll see how things happen tomorrow with PPI if this shifts around. But so far, we haven't set in any motion of whether we're going to go up or down from here. We're still going completely flat in this market and many other markets. And we saw some slight divergences between different markets, interestingly. The first one I want to take a look at is actually the 10-year Treasury note yield. I said yesterday, this is one of the main ones that I'm wanting to keep my eye on by itself, regardless of the break-evens. And we closed mildly higher today. I wouldn't call this a breakout. I had suspected that yields, I did say yesterday, I was thinking the 10-year yield might cool off here if it wasn't like super hot CPI reading. And instead, we actually rose a little bit for today. However, diverging from this, gold actually, this candle was today, not the following candle. This is on UTC time. Gold actually dropped by about 1%. And so if we were worried about the value of dollars in terms of gold going down due to expected higher inflation, we wouldn't expect gold to be dropping like this. While I keep track of the 2-year, 10-year Treasury yield spread, I sometimes like to look at what's going on with the individual yields themselves, this being the 2-year yield. Interestingly, while the 10-year is, jumping percentage, the 2-year is not. The 2-year with this little tiny green candle here, this is not a drastic change of expectations as to where we are with yields in the shorter term. And again, markets are going to typically be better at pricing the yields of shorter term Treasury securities. And the shorter they are, the easier they are to guess. I mean, just think of it like it's a lot easier to, suppose that we'll be within a 0.5 percentage point in the Fed funds rate within a month from now. It's either going to stay the same, go up 25 basis points or down 25 basis points. But if you're trying to predict 10 years out, 20 years out, 30 years out, that's a whole different ball game. And those expectations will, they'll change pretty dramatically, as they should, as as the butterfly effect. You have, one flap of one butterfly on one side of the world causing a hurricane on the other side of the world, kind of a thing. Or a ship being 1 degree off, sending you to an entire different continent when you go on a far enough trip. So while the 10-year rose in yield, the 2-year also not, along with gold, not really budging. I describe it Additionally, in the dollar DXY, spiking higher today. This move is not the market saying, uh-oh, the dollar's losing value. The dollar is still gaining value, folks. It's still going up. I did say yesterday, it looks like it's going up and it looks like it'll keep going up. And it did. And it still looks like it'll keep going up until it doesn't. Another market showing that we're not likely headed into further tightness is actually the 10-year minus 2-year yield curve. I've been talking about like we were getting real close to inverting again, and on today's CPI report, we're actually still spreading here, which in a way suggests that the easing, the power of closer term easing is more powerful. The expectation of further easing is increasing off of the back of today's data on this metric alone. Now, on this CPI news, I had also said that the Fed funds futures had been getting real close to 50-50 between pausing actually in the December meeting and doing one cut with, only 60% versus it was much higher before. So we jumped back up to 89% chance of a cut in December. So we're back to having that cut. The participants that were really worried about CPI being a lot harder were pricing it in with a good amount of power, and were wrong for today. So it's interesting. Going back to the 10-year chart with all of these things in mind, I'm thinking that today's bullishness in 10-year yields is actually a fake out, not a breakout. Again, for example, November 6th candle has a wick quite a bit higher here than any other wick before it or after it. I want to see if yields, longer yields really are going higher. I'll need to see a close actually above the top of this wick here, as this really was the breakout and peak above this very much longer trend line that I drew. Again, I show this every show, but I just love it so much, going from the top of 2021 in 10-year yields to this neckline of this humongous Head and Shoulders top. And so I'm thinking that today's candle is a breakout. We'll see. We're at that point now where the 10-year yield's been going kind of sideways, and it's yet to be determined if we are really headed higher here or not, in my opinion. I'm guessing not. I don't think long yields will go higher from here. Next item on today's agenda, a CNBC headline talking about AMD layoffs. And here it is screenshotted: AMD to lay off 4% of workforce, or about 1,000 employees. Wait a minute, you mean they're not hiring thousands of employees to make more and more and more semiconductors because the world needs an infinite number of semiconductors? No, they don't. I'm so happy to be short semiconductors right now. I'm just sitting on this short position now, very well in the money. The semiconductor ETF SMH, as I've been showing on many shows, dropping today. With all of these patterns lined up, this is just like an unbelievably powerful signal, chart pattern at least, that says to me that we are at least headed down to this neckline. I highly suspect we will break through it to go much lower. I think the market is finally waking up to the fact that trees actually don't grow forever, and these are just semiconductors. They're not Nike shoes. They have no wide moat. They're, I can open my own company and make these things. They cost a lot of money, but you get the point. The last headline of today, obviously the PPI comes out on Thursday, so we'll see how that moves things around. Oh, we also have initial jobless claims. That could be, if that spikes, could make things interesting. Before we get through the rest of the charts, the daily reminders are intact. Nothing's changed. If you want to hear me read through the very important daily reminders, watch Monday's show. Since nothing's changed in the daily reminders, nothing's changed in my ultimate crystal ball reading that the S&P 500 is currently priced as if it's a Ponzi scheme relying only on other people to bid the price higher instead of any kind of safe valuation. This is a very unsafe, speculative market, not a safe, cheap market that has a lot of potential for a higher price. There's a lot of potential for a lower price, in fact. And this is why, that along with all of the daily reminders, the crystal ball reading remains that there's a bear market imminent and the Fed won't cut fast enough to save the economy. Moving on to the charts, starting with the S&P 500, just as a baseline. I try to start every show, chart section of the show with this, mostly because it's the best, base as to where stock valuations are. And yeah, so we went like exactly flat today. So we need some time to digest CPI. Maybe we need to see what PPI looks like, what initial jobless claims looks like. It's going to take a lot of very powerful news at this point for the market to really rip higher here. I mean, think about it as far as elections go, and it's over. So as far as I can see, it's all already priced in. What news is there left to make things go way up or way down? I mean, maybe the S&P 500 had, bought the rumor and now we're selling the news. So this, this really could be a top, that magic 6,000 number. I'm not going to pull it up right now because it messes up all my charts when I switch to logarithmic mode. But if you trace the height, I believe it's of the 1929 market to the top of the dot-com bubble and continue it, that's exactly where we are right now. I brought that chart up before. I talked about it before. I think it's notable. It's in the stars kind of line there. Another market I was going to bring up at the beginning of the show, in looking at the comparisons of how markets reacted to the CPI report. Oil, again, not budging today, but intraday getting very close again to this this line that we've been just bumping along on seemingly forever. And with these smaller bumps at the end, you kind of wonder if it's time for us to break lower. This could really signal rates to go lower, and it's sniffing out faster slowdown in economies worldwide. The oil market is a world market, not a U.S. market. But yeah, also in terms of dollars, going flat today off of today's, basically non-event with the CPI coming in exactly as expected. TLT, still my favorite place to be. We're still within this wedge pattern here. A descending, broadening wedge after dropping is actually a typical reversal sign, along with the RSI divergences that I've been pointing out. It's not game over for long bonds yet. We're holding the line. Last chart of the day, wood. Wood did it. Wood is one of these leading indicators for me that I like. It's something real in the United States that involves people's real lives and expectations, specifically, with its usage for home building and also home remodeling, home fixing, home expansion, those kinds of things. And when wood is looking bearish, it can drive everything along with it. You can have markets follow wood. And I said yesterday, we broke this seemingly hand-drawn head and shoulders top here is almost like the market was actually had a kid with a crayon just drawing a perfect head and shoulders. We broke the neckline yesterday, and I said yesterday, I'll blow this up real big so you can see it. I needed to see a close, which on a red candle would be the bottom of the red candle. I needed to see a close below yesterday's wick, and we got that. So wood suddenly looking very bearish, not just with a pattern setup, but we had the breakthrough and then we had the follow through. This is not a fake out. This is a breakout. And so, when we go from the top to the line, 86 to 79, that's six, we'll call it 6 points. And then breaking at 79, we can expect this to drop to at least a level of $73, which we haven't seen in quite a while. So watch out for that PPI and maybe initial jobless claims tomorrow. You never know when that number will come out of left field with something that really shocks markets and sends waves through them. And that's all for me and my crystal ball. I hope you enjoyed, and thank you for watching. Robschild.